Ladies and gentlemen, good day and welcome to Gland Pharma Limited Q4 and FY24 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ankit. Thank you, and over to you, sir.
Thank you, Neerav. Good evening, everyone, and we welcome you to Gland Pharma earnings conference call for Q4 and FY24. My name is Ankit, and I head investments, M&A, and corporate strategy at Gland. Joining me today are Mr. Srinivas Sadhu, our MD and CEO, Mr. Ravi Mitra, our CFO, and we also have today Mr. Alan, the CEO of Cenexi, our European CDMO business. Together today, we'll discuss our business performance and address any questions that you may have. We'll begin with the business highlights on Gland and Cenexi from Mr. Sadhu, followed by an overview on Cenexi and the turnaround strategy from Mr. Alan, and lastly, the group financial review by Mr. Ravi. Before we proceed, I'd like to remind everyone that some of the statements made today may be forward-looking and based on the current estimates we have as management. These statements should be considered in light of the risk associated with our business. Please note that the call is being recorded and the playback would be made available today and the transcript would be available within this week. With that, I hand over the call to Mr. Sadhu for his opening remarks. Thank you. Over to you, Mr. Sadhu.
Thank you, Ankit. Good evening, everyone, and thank you for joining us for Gland Pharma's fourth quarter and fiscal year 2024 earnings call. This past year has been positive for Gland, marked by the significant rebound of our core business and the exciting new chapter we have begun with our first international acquisition of Cenexi in Europe. Despite the evolving business environment, we have demonstrated resilience and delivered a performance that exceeds last year's results and sets the stage for continued growth and success in the years to come. Let's delve into our fourth quarter consolidated performance. Gland achieved revenues of INR 15,375 million in Q4 FY24, a remarkable 96% increase compared to Q4 FY23. Not only did our recent acquisition of Cenexi contribute to this growth, but our base business also continued to grow. It highlights the ongoing strength of our core business, driven by the sustained market leadership of our key injectables and the successful introduction of new products. Notably, our EBITDA for the quarter rose to INR 3,587 million, a significant improvement over the INR 1,684 million reported in Q4 FY23. Our base business operations, excluding Cenexi, experienced substantial growth in Q4 FY24. Revenues reached INR 11,737 million, a significant 50% increase compared to the same period last year. Profitability also soared, with EBITDA margins hitting 37%, a 16% point improvement year-over-year. Shifting our attention to the full FY24, consolidated revenues reached INR 56,647 million, a substantial 56% increase compared to the previous year. While the integration of Cenexi played an important role in growth, we also experienced strong momentum throughout the year in our base business, growing by 15%, driven by new product launches, successful relaunches, and the continued market dominance of our leading products. Our consolidated EBITDA for FY24 amounted to INR 13,331 million, up from INR 10,248 million in FY23. Our consolidated EBITDA margins for the year were at 24% and were impacted by the inclusion of Cenexi, which is still in the process of reaching its optimal performance level. However, for the full FY24, our base business EBITDA totaled INR 14,140 million, a 38% increase from the previous year. Base EBITDA margins for the entire year also saw impressive growth, reaching 34%, a 6 percentage point increase compared to FY23. The board of Gland Pharma is pleased to recommend its first ever dividend to shareholders post-listing. The board recommends a final dividend of 2,000%, equivalent to INR 20 per equity share for the fiscal year ending March 31st, 2024, subject to the approval of our shareholders. In terms of our geographic performance, Our core markets achieved 59% revenue growth in FY24 and now represents 75% of our total revenues. We successfully introduced our 50+ new molecules to the market throughout the year, including regadenoson, ganirelix, doxycycline, octreotide acetate, carboprost, and ketamine. These launches included 30+ relaunched molecules that were temporarily unavailable due to challenges with some partners. Excluding Cenexi, the base business in core markets grew by 21%. Our key products, enoxaparin sodium, cisplatin, lacosamide, rocuronium bromide, zoledronic acid, and vancomycin continue to demonstrate strong growth, and we haven't observed any major price-related fluctuations. Looking ahead, we remain optimistic about the potential in these markets. We are confident in our ability to maintain our competitive edge through ongoing compliance, cost leadership, scale, and our diverse portfolio of offerings. Our core markets outside the US saw a significant boost from the Cenexi acquisition, achieving 3x growth during the fiscal year. We have been actively working to identify and capitalize on synergies with Cenexi, while also expanding our base portfolio in these markets with products already approved in the US. The rest of the world markets accounted for 20% of our revenue in FY24, an increase of 63% from FY23. This increase was primarily driven by Cenexi volumes. We have seen positive traction for some of our products in these markets, and we anticipate significant growth in the businesses we have recently established over the next 2 to 3 years. In contrast, the Indian market contributed 5% of our revenue in FY24, and we are currently evaluating strategic options to develop a well-considered future plan for this market. Turning our focus to research and development, our total R&D expenses for Q4 FY24 were INR 436 million. We filed 4 ANDAs during the quarter and received approval for 6 ANDAs. For the full FY24, R&D expenses amount to INR 1,773 million, representing 4.3% of our base business revenue. We filed 19 ANDAs throughout the year and received approval for 24 ANDAs. As of March 31st, 2024, Gland and its partner had filed 349 ANDAs in the United States, with 286 approved and 63 pending approvals. The company currently holds 1,667 product registrations worldwide. While our progress in the Chinese market has been slower than anticipated, we have filed 9 products so far, of which 3 have been approved. We have commercialized 1 product, but its contribution has not yet been substantial. We are actively collaborating with Fosun to reassess our approach and identify strategies to achieve more significant success in China, a vast market with considerable potential. Regarding complex injectables, we targeted to develop 19 molecules addressing a market size worth $9 billion as per IQVIA. To date, we have received 6 approvals, of which 4 products have been launched. We recently launched Eribulin as our first major complex product in this category. The next 2 years will be crucial for realizing meaningful results from our complex product portfolio. We are also exploring potential acquisitions, co-development, and in-licensing opportunities to accelerate our growth and strengthen our position in this segment. While biologics represent a long-term play, our immediate priority is to obtain regulatory approvals for our facilities through our existing business and potential near-term wins. Overall, biologics remain a key driver for our future growth. This has been a good year for quality and operations, with over 40 successful audits completed, including those by regulators and partners. All of our sites are operating smoothly and are in a state of control, with establishment inspection reports already received. We remain committed to maintaining compliance as a core pillar of our strategy, ensuring it's deeply ingrained in our culture and every business decision. Before I wrap up, let's discuss Cenexi in more detail. Alain, Cenexi CEO, will provide a roadmap for our turnaround strategy. Before handing it over to him, I would like to share key points. In Q4 FY24, Cenexi recorded revenue of INR 3,637 million, with a gross contribution of 77% and a negative EBITDA of INR 720 million. For the 11 months of FY24, revenue totaled INR 14,878 million, with a gross margin of 76% and a negative EBITDA of INR 812 million. The quarter's revenue decline of 18% was primarily due to operational disruptions, which led to a backlog of orders. Additionally, there was a delay in executing the tech transfer for the new business, which was intended to replace the phasing out business. We are actively investing in capacity expansion, capability enhancement, and optimizing of filling and packaging lines to ensure consistent execution. Our long-term turnaround plan also addresses critical areas like hiring needs, operational excellence, supply chain efficiency, and integrating value-adding technologies. While achieving the full potential of the acquisition has been delayed by a few quarters, the thesis behind the acquisition is intact, and we remain confident in Cenexi's strong medium to long-term outlook. We are committed to maximizing this business strategic value with a healthy order book, a strong customer base, many tech transfer projects, and promising growth opportunities. With that, I'll turn the call over to Alain, the CEO of Cenexi, who will share insights into the company's progress and strategy. Thank you all for your attention. Over to you, Alain.
Thanks, Sadhu. Good evening, everyone. My name is Alain Kirchmeyer. I took over as the Cenexi CEO and President in February this year. I'm happy to be in India and participate in this investor call for Gland Pharma Limited, our parent company. At this pivotal juncture for Cenexi, I am confident that we can leverage our industry expertise and the strong support of Gland and Fosun to capitalize on significant opportunities and establish ourselves as a leading CDMO in the European market. While the road ahead will demand focus, the groundwork is in place for us to achieve this ambitious goal and become the group's flagship CDMO company. As Sadhu highlighted, Cenexi is navigating a transitional period, and our performance is affected by near-term operational challenges. While the business long-term potential is substantial, we must overcome these hurdles to achieve our goals sustainably. With Gland's operational and financial support, we have initiated a comprehensive plan outlining detailed short-term, medium-term, and long-term goals to address these challenges, as detailed in the earnings presentation shared with you all. We are actively investing in asset upgrades, capacity rebalancing, and developing future-ready capabilities that align with evolving CDMO market demands and will drive Cenexi towards higher margin business. In the short term, we are implementing a plan to maximize site utilization through extra shifts, enabling us to normalize the order backlog. We have enlisted third-party support to optimize preventive maintenance and changeovers and minimize downtime. These measures will increase output from existing capacity and mitigate revenue decline. In the medium term, we will address line-level utilization challenges by moving some high-volume products within sites, enhancing flexibility, reducing format changes, and ensuring timely and efficient service. Additionally, we are accelerating technology transfer projects for faster new product launches, driving increased turnover. We are adding one new high-speed ampoule line in our Fontenay plant and evaluating further capacity increases for pre-filled syringes. We are also transitioning towards a leaner centralized corporate structure to streamline decision-making, reduce redundancies, boost agility, and foster a unified Cenexi culture. From a business development perspective, we are actively engaging with partners on high-margin, complex projects in biologics, complex generics, and NDAs, while leveraging the combined strength of Gland and Cenexi for enhanced market positioning. We also identify cross-selling opportunities and increase wallet share with our partners by mapping our customer base. Additionally, we are engaging in discussions with existing partners to optimize pricing and ensure profitability. In the long term, we envision Cenexi as one of the most advanced CDMOs, capable of offering a wide range of sterile injectables and consistently delivering high margins and profitability. Clearly, our immediate goal is to bring Cenexi back to profitability and in the medium to long term, deliver high teen margins. Thank you. I will now turn the call over to Ravi to discuss Gland and Cenexi financial performance. Ravi, please proceed.
Thank you, Alain. Good evening, everyone. I trust you have had the opportunity to review our financial results, investor presentation, and the press release we shared through the stock exchanges. Let me begin with an overview of our performance this quarter and the full year. Our business has demonstrated strength, contributing to a 96% year-over-year surge in revenue from operations and amounting to rupees 15,375 million in Q4 FY24. This robust performance, coupled with the successful integration of consolidated revenue from our recent acquisition of Cenexi, has propelled our total revenue for the fiscal year FY24 to rupees 56,647 million, a significant 56% increase compared to the previous year. The revenue excluding Cenexi also grew by 50% in Q4 FY24 on a year-on-year basis and 15% in FY24. Other income for Q4 FY24 reached INR 421 million, primarily consisting of interest on fixed deposits. This represents an increase compared to Q4 FY23, which saw INR 389 million in other income due to positive forex movement. For FY24, total other income amounting to rupees INR 1,702 million. This figure is lower compared to FY23 due to lower interest on fixed deposits and lower foreign exchange gains from operations. Our gross margin for Q4 FY24 reached 61%, a notable improvement from the 54% recorded in Q4 FY23. Cenexi's high gross margin profile primarily drove this year-over-year enhancement in gross margin. Additionally, we are pleased to report that our base business also experienced an improvement in gross margin to 56% compared to the previous year. In Q4 FY24, we achieved an EBITDA of 3,587 million, a 113% increase compared to the INR 1,684 million reported in the same quarter of the previous financial year. Our EBITDA margin for Q4 FY24 stood at 23%, up from 21% last year. For FY24, our EBITDA reached INR 13,331 million, a 30% increase compared to INR 10,038 million in the previous financial year. However, the EBITDA margin for FY24 was 24%, lower than the 28% reported in the last year consolidation of Cenexi. We are actively implementing corrective measures to ensure Cenexi's business rebounds to its expected margin levels. In contrast, our base business, excluding Cenexi, achieved an improved EBITDA margin of 37% in Q4 FY24, significantly higher than the 21% reported in the same period of the previous year. For FY24, the EBITDA margin of our base business stood at 34% compared to 28% in FY23. Our net profit or PAT for Q4 FY24 increased substantially by 145% year-over-year compared to Q4 FY23, reaching INR 1,924 million. For the full FY24, our PAT amounted to rupees 7,725 million. Although this marks a slight 1% decline compared to the previous year, it's important to note that this was achieved despite losses at Cenexi, which were offset by significant growth in profitability from our base business. Our PAT margin for Q4 FY24 was 13% and 14% for FY24. Notably, our base business, excluding Cenexi, achieved a significant improvement in PAT margin, reaching 25% for FY24 compared to 22% in the previous year. Total R&D expense for FY24 amounted to rupees 1,773 million against rupees 2,014 million in FY23. This represents 4% of our revenue from operations, excluding Cenexi. On a standalone basis, our effective tax rate was 26% in the fourth quarter and for 12 months of the current fiscal year. On a consolidated basis, the ETR went up to 35% in Q4 FY24 due to the absence of a deferred tax asset at Cenexi for the PBT losses during the year. As of March 31st, 2024, our total cash and equivalents on a group total level stood at rupees 24,953 million. However, considering the outstanding loans on Cenexi's books, our net cash position was lower at rupees 21,756 million. During the 12 months ended March 31st, 2024, we generated 9,968 million in cash flow from operations. As of March 31st, 2024, net working capital was at 24,074 million in FY24, compared to INR 24,010 million in FY23. The net working capital remained flat despite increased revenue due to a decreased inventory level. Our average cash conversion cycle improved, reaching 169 days for FY24, compared to 256 days in FY23. We invested rupees 3,975 million in capital expenditures during the current fiscal year. Of this amount, rupees 2,368 million was spent on upgrading and setting up production lines and routine maintenance at our facilities in India. Balance of CapEx spent at Cenexi will positively impact performance with reduced downtime and lower maintenance costs. With that, I will turn the call over to the moderator to open the floor for questions and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Sayan Mukherjee from Nomura. Please go ahead.
Yeah, thanks for taking my question. Just wanted to check on Cenexi. So, from the current level to break even to high teens, what's the kind of timeline? If you can give some more granular details on the key milestones that we should look out for as far as the EBITDA margin improvement is concerned with the timelines, please.
So Alan speaking, I will take that question. So our goal to reach high teen margins is a mid to long term goal, and there are a number of actions that we have to take. The first one, as you've seen in the presentation, is to fix our operation issues and improve our operational results. The second one is to speed up our tech transfers to our HSC site in France, and of course continue on all the business development actions that have already been initiated to gain new customers. And for that, we need, of course, to invest in new CapExes to increase our capacity.
Yeah, actually, I was just looking at, how should we think about Cenexi EBITDA for next fiscal and the year after? And just to understand what your mid to long term timeline means here, actually. So if you can guide for FY25 and 26 on Cenexi.
We're looking here at a mid-term goal, meaning typically 1 to 2 years.
Okay. So in 2 years, you're expecting to get to high teen EBITDA margin here. Okay.
Yes.
And and thanks for that. And just one question on the base business. We have seen a very strong recovery here with US and other markets, growing EBITDA margin getting to 37%. So, Sadhu, how should we think about, this number going forward? We are seeing good traction. Maybe you will have more products and the partnerships coming in. How should we think about EBITDA margin, gross margins as the business kind of, stabilizes and grows from here?
Yeah, I think the pricing wise it kind of stabilized. If you see year on year, its price is almost same. I would say 1% negative, I would say, but it's almost same. But the relaunches, what we have done, what we have lost last year, everything got relaunched. So that kind of brought back the volume. So if you see the combination of our new product launches and the relaunches, almost 17%, that is, got back the numbers what we had. In addition to that, if you look at our top 10 products, almost 8 products, they have grown substantially, including enoxaparin. We got the contracts back what we have lost earlier. We are aggressive in it and did several things to work on the cost. So could get a few major contracts back. So the growth on those are almost like, 2 times, 3 times. And they were, of course, the enoxaparin business, we are always saying it was a temporary, they were not taking up. So if you see what we have done in last 2 quarters and, the first 2 quarters is completely different. And so we're headed back to what we've been guiding the market in terms of volumes in 19-20 million syringes. And we're also looking at little bit higher opportunities as well. So a lot of products are, took actually what the market shares what we had earlier and became strong. So kind of confident on those because we kind of got back the GPO contracts. And margins are also kind of stabilized, the regulatory landscape, what's in the market. So that also helped us in some of oncology products. We got a good market shares, products like 5-fluorouracil or, platinum, So that way the base business is improving. I would say it's more stabilized now.
So sir, now the run rate that you have in the base business in the US, so is that stable? How much can it grow? And then on top of it, you will have new launches. If we can just talk about the headroom that's available with all the disruptions and your recovery from what we have seen in this quarter.
So we kind of guided last time also. I think we still want to stick to that about 15%, around 14-15% on an annual basis growth rate. Combination of the base and the new launches for the end because now it's a larger base, right? So we want to stick to that.
Okay, so just if I can ask one last question. What is the milestone and profit share number if you can share for fourth quarter and for full year?
It's in the similar range, 2-3% this way, that way. What we have to understand, we're also doing now some complex products. So milestones will be a little higher than earlier, so probably a couple of percentage. But otherwise, on an annual basis, still it's similar range.
Okay, thank you.
Thank you. Next question is from the line of Amey Chalke from JM Financial Services. Please go ahead.
Yeah, thank you for taking my question and congratulations to the management, good set of numbers. So the first question I have is related to FY25 outlook. Like this year, we have seen a good amount of contribution coming in from the new product launches. Are we expect to replenish the similar kind of sales from the new products next year? Because I expect there would be some price erosion happening, which could be substantial for the new products which have been launched last year. And the second thing which I have, second question I have related to this is, generally when we have seen a CRAMS player supplying the products, we see the fluctuation of volatility in the contracts. So if we have seen a good amount of ramp up this year, do you expect that similar kind of contracts to get repeated next year, or you think the inventory adjustment could happen that could drag the growth a bit next year? Thanks.
Yeah, so when you're saying new launches, I did mention that a lot of these are relaunches. With about 30 plus molecules we relaunched what we lost last year because of the happiness and allergen exiting the market. So that got relaunched. So kind of got back the product volumes what we lost. So it's not like these are new products where the pricing erosion will happen because it's already like very generic products where it's already kind of settled. So real new products what we launched in terms of the entire business what we have grown, will not impact that will not impact that much in the scheme of things in terms of new launches, how much it has contributed to the growth. The other question about one second. Yeah, so you were talking about the contracts, right? The volatility of the contracts. A lot of contracts what we signed recently, it is the second part of the year also. So if you actually annualize it, the volumes will increase because we signed some in last quarter, some in the previous quarter also. So it's actually not the annualized numbers. That should have stabilized. Like you said, initially there will be a higher offtake because I think they also fill the pipeline. But you need to consider that, if you see the numbers, it's going up from third quarter to fourth quarter. So most of these contracts are signed and getting launched those quarters as well. So even now, some are still not yet launched. So that way, once you annualize it, I think it should balance the whatever you're talking about, the initial uptake.
Sure. The other question I have is on the biologics. It's been a while since we had acquired this unit. What steps we have taken to ramp up our position in this space, and how we can increase the utilization of this unit?
Yeah, the efforts are there, small projects we are doing, but, biologics normally takes a longer time compared to others. And in last 1 year, so many headwinds on different aspects. The focus was how to get the base business back, and a lot of efforts went into that set in terms of how we need to reduce our costs and be more competitive. And also, the interest situation in the US, a lot of funding has stopped, and whenever you have a new asset, especially guys entering into the biologic space, you need to work with the smaller development companies where the funding has stopped. So efforts are there and continuous discussions are happening. So that will, I would say, it's a slow process, but we have to stay there because on the CDMO side, that's the area we want to grow in the near future. So currently, it's more on technical side and skill development and people strengthening. That's what we're focusing on, and I think that's once you have that, everything else should follow.
Sure. Thank you so much. I will join back.
Yeah.
Thank you. Next question is from the line of Bino from Elara Capital. Please go ahead.
Hi, good evening. Couple of questions. One, could you comment a bit on the opportunity in this eribulin product? As I see, you are the only approved generic in the market. Do you expect competition near term?
It's around $170-180 million product, and we are the first ones to launch. And we just launched last month, so we have to see how the market behaves because, a couple of people have filed it. We don't know the approvals yet, what stage they are in. But generally, when you are the first in line, you tend to get the contract. So we're just hoping good results from the market. But just to give a number, it's too early, I would say.
Okay. So a normal assumption would that over the next 6 to 18 months, you may see 1 or 2 more entrants in the market?
No, you might see some it's too. I can't really comment on somebody's filing, but you can see next 6 months, but I'm not sure.
Understood. Second, if I remember, last year there was a planned shutdown in Cenexi during summer holidays, etc. Is that a routine thing, or will that happen this year as well? And which months would that be?
Give me a second. So the plan is this year, I think I did mention the last call that we are trying to invest in a new line. So the plan is we're pushing the supplier to get that line before that shutdown happens, so that we can utilize that time for the installation of the line. So that once these lines get added, then we can have additional capacity. Where today we're struggling. Today the issue is not orders. We have a 20-25 million euro orders of backlog, and the constraint is the capacity. So I would say that's the steps we're taking so that we can install this new line during that time.
Okay, so shutdown is happening. Which months would that be?
That's August.
Yes, August. Okay. And last, just one question on tax rate. This year, the overall concern tax rate has come to 35%. It's a big jump over last few years. So the concern is the tax rate we are looking forward to in the next few years.
Sorry, you're breaking down. You're breaking up.
Sorry, I was asking this year the tax rate has jumped to about 35%. Why is it so? And over for next 2-3 years, what's the tax rate effective overall?
So currently the 35% is because there is no negative tax or deferred tax asset created at Cenexi level because of the losses. However, the normal tax rate at Cenexi is 27% in France. So the time it starts to be at PBT positive level, this tax rate will surely come down. Which we expect in.
Thank you.
Thank you. Next question is from the line of Charul Agarwal from Bank of America. Please go ahead.
Hi, am I audible?
Yes, ma'am.
So my first question is on the US revenue medium-term growth. So when we think about the ramp-up of US base from here, how do we look at it in terms of drivers? How much of it would come from new product launches versus adding partners in the existing product?
So with the large base we have, we still see 3 to 4% coming from the pure new launches and some, the relaunches. So normally it's around 10%, 10 to 11% is the growth we get from the launches. Combination of relaunches and purely new products.
Cool. So the other proportion is it basically expanding market share from the current partners itself, or do we see scope of adding new partners in the products that we have?
So it's a combination of both. So basically, you want to increase the market share, then you add up both, right? So it's a combination of both, but mostly getting into some contracted situations like just like I said, some we have entered the large products into the contracts, which gets annualized. The growth will come from those markets also. So whenever these GPO contracts are opening up, we are focusing on how to get those contracts in.
Okay. Thank you, sir. So my next question is on Cenexi. So this quarter we have seen higher costs for the business. So going ahead, how do we see the cost from this level? Do we expect to incur additional costs over this, or can we see this as the base?
So this cost related to typically maintenance all will come down. And we expect there would be lower cost base in actual terms also. As we complete our expansion and the volume grows and fixed cost gets more utilized. So on a percentage term basis and as well as absolute term, we would expect cost to be lower than today. Of course, there will be certain inflation to counter that.
So, sir, this would start reflecting from the next quarter as well, or do you expect this to happen a few more quarters down the line?
It will take a few more quarters because as Mr. Sadhu was just explaining that there is going to be a new line, a high-speed line, which is being installed in September quarter. And post that, we would expect the volume to grow up.
Okay. So the absolute cost as well will happen from after the September quarter, or is it the revenue ramp-up that you were saying will happen after the September quarter?
No, so September quarter, the installation will start, and then it will take a quarter or so to start the commercial and ramp up to happen.
So we are expecting an impact Q1 next year, Q1, Q2, depending on how the ramp up goes.
Got it. Thank you, sir. That was my question.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. Next question is from the line of Shyam Srinivasan from Goldman Sachs. Please go ahead.
Yeah, good afternoon, and taking my question. First one is on Cenexi. For the 11 months, I think in euro terms, we have done a revenue of 166 million. I'm just annualizing it for the 12th month. It's around 180 million, and maybe I'm wrong. But this used to be a 200 million run rate. So is the 20 million, is that the lost opportunity that we have seen because of some of the challenges? And for the quarter, I think it came at 40 million euros. So just if you could help us quantify what is the missing part that should have ideally come through this quarter and may actually flow through potentially in the future?
So, like you mentioned, about 20 million is the backlog orders we have in order to supply because of the operational issues we are facing. So that itself should cover the difference what you mentioned. So it's a slow ramp up. 40 could be your the base, and you'll see a slow ramp up of the revenue. And any revenue add, if you're seeing the gross margin is 77%, it just flows down to the bottom line. So the initial focus now is how to make it more efficient, the line, so that your output will increase, so that you can make more supplies and the top line increases automatically, it flows down. And then work on the new lines in parallel. So we have unlike Gland, where we have we put up a new line, we have space, and then we remove the line, we transfer products. We don't have that kind of flexibility there. We have to work on because the capacity is 100% utilized today. Several lines where the demand is high, so we have to partially take some action so that it will not impact the running business. At the same time, install lines and newer machinery so that it helps to grow the business. So it's a little different ballgame compared to what we do here.
So, Mr. Sadhu, sorry, I'm unable to understand. So I get the 20 million order backlog, but should we look at quarter one, quarter two, quarter three when we look next fiscal for Cenexi? Is it the 40 million run rate is what we think we can do, or there is a ramp at some point of time?
It will ramp up. It will ramp up slowly. Could be from 40, it might go to 43 and 45, something like that. Yeah.
Yeah, and at what time, when we reach the 50 million run rate quarterly, I'm looking historical numbers, that's when we reach whatever the pre-acquisition run rate of about 200 million euros is when we'll potentially get the EBITDA margin to be positive. Would that be fair? Hello?
Give me a second, I'm just talking, yeah. Around 3 quarters to get to that 50 million quarter number.
Okay. And at that phase, at 50 million, we should be having positive EBITDA. I'm not asking you to quantify any specific margin number, but do you think that is where?
Yeah, that's correct.
It's longer than that.
Yeah, that's correct. Yeah.
Understood. Okay. Thank you. Second question is just on the whole shortages scenario in the US. Some of the data, external FDA data seems to suggest it's at a multi-decadal high. So what are some of the benefits that we may have accrued? Do we benefit from it? In the past, Mr. Sadhu, you have told us it's very cyclical. So it may come some year, goes away some year. But do you think, given the kind of focus on trying to reduce shortages, could this be a sustainable advantage longer than usual? And when we look at the margins of 37% for the quarter, is there an element of shortages that is helping us reach that? Thank you.
I don't think there's shortages, at least for this quarter, which has helped that. But this shortage has been happening for many, many years, and with more regulatory issues in the recent past, it has increased. It's very difficult to say, when it will go away. And on the oncology side, we did get the benefit out of it. Earlier, we were not competitive enough to compete in that space, but because of the shortages, we did get benefit of certain products for sure. But timing-wise, I can't really say how long this will stay. But historically, consistently, you saw the shortages in the US market. And there's a combination of how many people won't actually sell these products because the margins are low, and being only injectables, we kind of stay there.
Got it, sir. Thank you, and all the best. Thank you.
Thank you very much. As there are no further questions, I'll now hand it back to Ankit, sir, for closing comments.
Thank you everyone for joining today. We appreciate your participation. If there are some questions which are still answered, you can reach out to us. Thank you once again. Looking forward to host you again next quarter.
Thank you very much. On behalf of Gland Pharma, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.